The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Life and Annuity Unanswered Tax Questions. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber, and welcome everyone. I'm glad you joined us today. It's hard to believe it's already December, but there you go. We're going to talk today about life and annuity unanswered tax questions. As a reminder, next month we will discuss the new 2025 numbers that affect income taxes, gift taxes, estate taxes, pensions, and some other things. That's what we do every year. I hope you'll join us for that session. Instead of the very first Wednesday of the month, we're going to hold that webinar on January 8th, since January 1st, New Year's Day is the first Wednesday. We'll have it at our usual time, 11 o'clock Central, and if for whatever reason you miss, you can catch the recording of that session or this session on our YouTube channel. These webinars are open and free to anyone who is in the life insurance business or is otherwise a financial professional. So if you feel like you know a person who could benefit from hearing what it is that we have to say, feel welcome to invite them to join the webinar. Before we get started on today's topic, let's go ahead and vote on next month's or the February topic. So you'll have a chance to vote for one of these three. The first choice is reviewing Form 1099 LTC. Second choice is understanding net unrealized appreciation, which goes by the acronym NUA. And the third choice would be managing life insurance issues during divorce. The poll is now open. Go ahead and vote for your choice, and I'll give you a few seconds for that. Still waiting on a couple more votes. I'll give you just a few seconds. All right, I'm going to go ahead and close the poll. Next month's topic will be understanding net unrealized appreciation. Thank you for voting. I said next month's, it's actually February's topic. So let's go ahead and get started with today's life and annuity unanswered tax questions. There are lots of unanswered tax questions related to life insurance and annuities. And I'm always surprised when Jennifer and I get callers that don't quite believe it. But there are a lot of ideas that people in our business come up with, a lot of strategies that their clients are interested in pursuing And Congress, the president, and the IRS don't always get together to provide final answers to some of those questions. But I'm going to talk today about 4 of the most common questions that we get. The first of which is, when we've got a company-owned non-qualified annuity, when does the penalty tax apply? The second question that we'll discuss is third-party ownership of a life insurance policy and the potential income taxation of chronic illness acceleration benefits. The third thing that's not been answered is, how long does there need to be between a withdrawal and a subsequent 1035 exchange to avoid taxable boot rules? And then the last question is, how do you value a policy when the insured's health has deteriorated? How do you value that policy for gift tax purposes? So let's go ahead and get started with the first of those questions, and that has to do with a business-owned non-qualified annuity and the penalty tax. So in the way of background, one of the things that is in the tax code is this, and that is that if an annuity is owned by somebody other than a natural person, then the annuity loses its tax-deferred buildup. The code is explicit, as you can see in subsection B, that the income on the contract shall be treated as ordinary income received or accrued by the owner during the taxable year. Who's a natural person? Businesses are not natural persons. A trust could be treated as a natural person if all the beneficiaries of the trust are real people. We're not going to get into that. That's a whole different issue. But the specific question that we're going to talk about today is the penalty tax. And the question is, it's clear under the code section that we have in front of us on the slide that the growth every year is income taxable. And the question is that growth that is income taxable also subject to the penalty tax? And there's a different code section that says when the penalty tax applies, and that's code section 72Q for a non-qualified annuity. And it says that if a taxpayer receives any amount under an annuity contract, the tax is increased by 10% unless the taxpayer is older than age 59 and a half generally. That's the exception to the penalty. So if we've got somebody younger than 59 and a half, the penalty tax is supposed to apply. Well, on the one hand, it's possible to argue that if a company owns an annuity contract and it is paying tax on the growth every year, the company is not taking any distribution, and therefore the distribution is not subject to the penalty tax. But if you look at the language of 72U, the language in subsection 1B says the policyholder shall be treated as ordinary income received or accrued. So that code section basically says that you're going to be taxed like you receive the money. And code section 72Q, when it talks about the penalty tax, it says that when money is received by the taxpayer, you get hit with the extra 10% penalty tax. And because a corporation can never reach age 59 and a half based on the logic of some other things the IRS has published, there's an argument that can be made that the penalty tax will always apply to the taxable growth of an annuity when it's owned by a non-natural person. But we don't know it for sure. The IRS has never told us for sure whether the penalty tax applies or whether it's just ordinary income tax on the annual growth. So that's why the question is unanswered. We don't have clarity. The IRS has never said anything in either private letter rulings or in any kind of regulations that would give us a definitive answer to this question. So that's why we don't know. Let's go on to number 2. which involves third-party ownership of a life insurance policy and potential chronic illness accelerations. Now, we've got Code Section 101G that makes clear that an amount received under a life insurance policy on the life of an insured who is chronically ill, that's an acceleration for that is treated as a death benefit, and a death benefit is income tax free. But we've got this competing code section which talks about special rules for chronically ill people. And that section says that an acceleration for chronic illness isn't tax-free unless it's in exchange for payments for costs incurred by the payee that for qualified long-term care services for the period. And that implies that it's the payee who has to be liable for the long-term care services that are rendered in order for the benefit to be tax-free. We don't know that that's true. And when does this come up? Well, the common way that the question comes up is like this. We're asked to consider the situation where the insured wants to have the life insurance policy death benefit excluded from the insured's estate. So we have an irrevocable trust on the life insurance policy. And the irrevocable trust owns the life insurance policy, the insured becomes chronically ill, and then the trustee decides to exercise the chronic illness benefits. And under those circumstances, the question is, will the benefits be tax-free? And there's an ambiguity built in, as we discussed. As you can see yourself from the sections of Code Section 101G that are on the screen, it's not clear whether third-party ownership of the life insurance policy will make the benefits paid to the third party tax-free. What is clear, and this part of the code section is not reproduced on the screen. What is clear is that if a business is the owner of the life insurance policy, and the business decides to accelerate the death benefit due to the insured being chronically ill, those benefits are not treated as a tax-free death benefit. But if we've got a family member, third-party owner, or an irrevocable trust third-party owner, it's ambiguous as to whether the benefits are tax-free. We've got nothing from the IRS that says for sure one way or another. And so that's why we don't know the answer to the question, are chronic illness acceleration benefits taxable or tax-free when a third party owns the contract? Third question that we want to talk about today is a question related to taxable boot. The idea of taxable boot for some people is a new one. It comes in connection with a 1035 exchange. It is possible to do a tax-free exchange of a life insurance policy for another life policy, or for a life insurance policy to be tax-free exchanged for an annuity, or one annuity to be tax-free exchanged for another. The problem arises is that when the taxpayer receives something as part of the exchange, money or other property, that amount that it's received is known as taxable boot. And boot is taxed a different way from ordinary distributions, at least with regard to life insurance. Boot is taxed gain first. Well, what's the deal? How does this come up? Well, if somebody holds back money as part of a 1035 exchange, or if a loan gets extinguished as part of a 1035 exchange, doesn't transfer over to the new policy, that's when the question of boot comes up and when the taxpayer may get an unexpected income tax result. Now, the IRS, in a private letter ruling from more than 30 years ago, was asked to talk about a situation where somebody took a cash withdrawal from the life policy shortly before doing the exchange of the remainder of the cash value to another life insurance policy. And the IRS in that private letter ruling said, look, we're going to mash those steps together. We're going to say that the distribution you took out on Monday, followed by the exchange on Wednesday, that Monday distribution was part of the same transaction, and therefore we're going to treat it as taxable boot. And so that's the problem that was run into in the private letter ruling. A distribution shortly before an exchange caused the IRS to mash those steps together and produce an unexpected tax result. The logical follow-up question under those circumstances is, how long do the transactions need to be separated in time so that the IRS won't mash the steps together? It's a great question. It's the right question, and we do not know the answer. As carriers have decided to implement arbitrary timeframes between withdrawal and subsequent exchange for 1099-R reporting purposes. In some cases, it's 6 months. In some cases, it's same calendar year. They're all over the place there. But we don't know what the right answer is because the IRS has never told us when we will be safe from the possible imposition of step transaction in a taxable boot situation. So it's another question we don't know the answer to. And then the last question I want to talk about is policy valuation. The question of policy valuation for gift tax purposes comes up usually when we're transferring an existing life insurance policy to an irrevocable trust. We have some regulations from the IRS that explain how life insurance policies are supposed to be valued for gift tax purposes. In most cases, we're usually using the interpolated terminal reserve plus unearned premium. That's a rule the IRS has had in place for many, many years. In a lot of cases, the interpolated terminal reserve is a number that's very close to the policy's cash value. That's the good news. That's the clarity that we've got in the regulations. The lack of clarity comes from the exceptions that are also listed in the same regulation. The IRS told us in the regulations that when the transfer of the policy is close to its time of purchase, the value of the contract should be the purchase price rather than the interpolated terminal reserve plus any unearned premium. The second rule is that where we've got a paid up policy, we should be able to figure out the value of the policy because the value would be the cost of the policy for someone at the same age as the insured's current age. The third rule is that when we've got indebtedness, we can adjust the interpolated terminal reserve value for such indebtedness. But the kicker is number 4, in that if there is something unusual about the policy or the circumstances that would make a different valuation method appropriate, we can't use interpolated terminal reserve. And the IRS hasn't given us a specific alternative. Now, since this particular regulation was published, the market for life settlements has become much more robust. And I am of the opinion that someday the service will come up with new regulations for gift tax purposes that rely on the life settlement value of the policy to be the gift tax value of the policy. But we're not there yet. And the market for life settlements is probably not mature enough for there to be an agreed upon value for a life policy for gift tax purposes that relies on life settlement values. So there you go. That's a long-winded explanation for us to say that we don't know the answer to the third question either, which what effect does a deterioration in the insured's health have on the value of the policy? When do we have to use some valuation method, undefined, to value a policy where that has happened? We just don't know. All right, let's conclude. So a couple of things I think I'd like for you to take away from today's session. What does a professional advisor do when there's no final answer to a client's reasonable tax question? Well, that type of situation, I think, separates great financial professionals from just the good ones. And I think the real advice is this: where we've got a situation where we've got ambiguity, let's get everybody together. If it's a big enough ambiguity that has the potential to create big enough tax problems for the client, if it's answered in the wrong way, then let's get the client's other advisors involved. Let's have everybody agree on a way forward that everybody's comfortable with. I'd like to thank you again for joining us today, and I'll turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the second Wednesday of next month, January 8th, at this same time. Next month's webinar will be titled Relevant 2025 Numbers for the Financial Professional. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.